Hey everyone, last year I did a video on hotel industry in India where I explained the key trends in the sector and top stocks that would benefit from this trend. I clearly mentioned that there's a multi-year upcycle that has started in hotel industry and it would last for a few good years. If you look at the performance of these hotel stocks, Indian Hotel was at around 420 rupee and today it is at around 570, giving nearly 40% return. Lemon Tree was at 107, today it is at 140, giving 30% return. EIH Hotel was at around 250, today at 393, giving around 60% return. Chalet Hotel was at around 535, today at 816, giving around 60% return. So it has been a great rally so far. Now in today's video, I want to discuss the fundamentals of a very interesting hotel company that recently had its IPO a few months ago. Company name is Samhi Hotels. It had its IPO in September 23 at rupees 126 and currently the stock is trading at around 218. So there is a strong uptrend in share price. In fact, when I started my research a few days ago, Samhi was at around 200 and the stock has already jumped around 10% in the last few days. Still, the valuations are decent as compared to its peers. So in this video, we'll look at 7 important aspects of the company. First of all, Samhi has a unique business model. So I'll look at the business model and we'll explain why it is unique. Second, Samhi is currently in loss at PAT level. So we'll understand why is it at loss at PAT level. Then we'll look at the opportunity in hotel sector with current upcycle. Next, Samhi does not have individual promoter. It's a professionally run company. So we'll understand this aspect. Then we'll look at Samhi's growth plan, its valuation analysis vis-a-vis its peers, and finally the key risk. But before we begin, just a disclaimer that this video is only for education purpose. Please do your own research before investing your money. Alright, let's get started. Samhi Hotel was established in 2010 where its business model is to buy underperforming hotels and revamp them using their proprietary asset management tools. Then it ties up with top hotel brands of the world that manages the day-to-day operation of the hotel and include brands like Hyatt, Marriott, IHG that owns brand like Holiday Inn. Then Samhi pays them a fee for using their brand, which is typically around 5% of their revenue. As of today, more than 40% of all Fairfield by Marriott Hotel in India are owned by Samhi. And around 71% of Holiday Inn Express Hotel in India are part of Samhi's portfolio. So company does not build hotel from scratch. It follows an acquisition-led strategy. Now you might ask, what are the benefits of buying underperforming hotel and revamping them? So first of all, if you build a hotel from scratch, it takes somewhere around 3 to 5 years to get the hotel up and running. Whereas revamping an underperforming hotel is a much faster process and hence the inventory is ready in much lesser time. So that's advantage number 1. Second advantage is when Samhi Hotel, let's say, buy a 3-star hotel and revamp it to say 4-star, then it directly results in improving the profitability of the company. Then another important point here is hotel industry caters to different type of tourism. It mainly include business travel and leisure travel. So some hotels focus on both, whereas some try to focus on specific segment. That's why Samhi Hotel is focused on the business travel segment and caters to hotels in gateway cities. And that's where company has a wide portfolio of 31 hotels with around 4,800 rooms across 13 cities of India, including Bangalore, Chennai, Hyderabad, Pune, Goa, Mumbai, Ahmedabad, Jaipur, Gurgaon, Delhi. Company caters to 3 segments: upper upscale that include 22% of its room with brands like Hyatt, Sheraton, Courtyard. Then upper mid-scale contribute 45% of the room with brands like 4 Points, Fairfield by Marriott, and mid-scale include 33% with brands like Holiday Inn Express. Okay, before we proceed further, it's very important to understand that the hotel industry is highly cyclical in nature. It essentially means that there are periods when hotel sector makes a lot of money and there are periods when the profit growth falls significantly. And today we are in upcycle in hotel industry that would last a good few years. Now it's important to understand why we are in upcycle in hotel industry. And the answer is linked to supply and demand game. Let us try to understand this in detail because that will give you a clear picture about what you can expect from hotel stocks in near to medium term. If you look at the period between 2008 to 18, the supply in hotel sector was very high, where hotel rooms jumped from around 50,000 in 2008 to around 1,50,000. However, the demand was not that high in comparison to supply. Basically, a person would have many options to choose due to high availability of room because of oversupply. And hence, the room occupancy of hotel companies was on lower side. And due to oversupply, there was high competition and hence hotels have to keep the room at lower rates. But that trend has changed significantly in last few years. Especially post-COVID, there's a sharp increase in travel and tourism, and airline sector has boomed in India. As a result, the demand for hotel rooms has jumped significantly. It is growing at nearly 8 to 12% CAGR rate. However, the supply in the last few years has grown at just about 3 to 6% CAGR. It has resulted in high demand for hotel and hence higher occupancy rate and high room rate. This is where things get very interesting. Let me explain it with an example. So let's say there's a hotel ABC that has 100 room and the average cost of a room is 5,000 rupee. Now let's say out of 100 room, 50 rooms are occupied on an average. It means on an average, hotel would make a revenue of around 2.5 lakh a day. Or you can say that company has a RevPAR, that is revenue per available room of 2,500, which is calculated by multiplying hotel's average daily room rate by its occupancy rate. Now let's say there are many other hotels in the area and number of visitors are low. As a result, hotel occupancy fall from 50 to 30 rooms per night on average. And due to high competition, hotel has to reduce its average room rate to say 4,000 rupee. Now in that case, hotel revenue would fall to 1,20,000 and RevPAR would fall to 1,200 rupee. Can you see the difference here? Because of high supply of room and low demand, hotel revenue has fallen more than 50% from 2.5 lakh to 1.2 lakh per day. Please note that hotel would always have a fixed cost that includes staff salary, hotel maintenance and so on. So let's say per day cost of hotel is 1 lakh. In that case, when hotel was having 50 room occupancy at average price of 5,000, it was making a revenue of 2.5 lakh and after subtracting the cost, it was making 1.5 lakh. However, when the occupancy fell down to 30 room with an average room rate of 4,000 rupee, its revenue fell down to 1.2 lakh. And after subtracting the cost, hotel made a profit of just about 20,000 rupee. Can you see the sharp difference in profits? Now imagine there's a high demand for hotel because of increasing number of tourists. As a result, out of 100 room, 80 rooms are occupied on average, and also because of high demand, the room rate goes up to 7,000 rupee. In that case, hotel would make a revenue of 5.6 lakh rupee per day or RevPAR of 5,600 rupee. Subtracting the fixed cost of 1 lakh, it would make a profit of 4.6 lakh rupee a day. Look at the sharp change in hotel profitability because of supply and demand. Interestingly, today we are in phase where the demand is very high and supply is on lower side. As a result, hotels' occupancy rate has gone up and the room rates have also gone up and hence they are making huge money. Of course, to cater to this growing demand, hotels are coming up with new capacities and eventually will reach a point where there would be enough supply of hotel rooms to cater to the demand. And that's when we would see the occupancy rate stagnating or even falling. And even the room rates growth would stagnate. And that's where the hotel sector upcycle would end. But that process would take a good few years. Now coming back to Samhi Hotel, company's RevPAR has grown consistently from 3,193 in Q1 of FY23 to 4,248 in Q3 of FY24. The highest RevPAR growth has come from the upper upscale segment, and interestingly, company said that RevPARs are expected to maintain upward trend driven by continued office space absorption and growth in air passenger. Going forward, all eyes would be on RevPAR growth because that is one of the biggest factor in deciding company's profitability. By the way, friends, I also own a couple of hotel stocks in my portfolio and riding this upcycle. So far, I've got great return in one of the stock and recently I've added another stock from hotel sector. And I've shared the detail in my latest weekly video where I shared one exclusive video per week. In my last video, I shared my own portfolio details. In addition, I also discussed key government initiative and top sectors and stocks that can benefit from it. And I'm closely tracking nearly 300 plus super stocks and identifying investment opportunities. In case you are interested, I've provided my website link in the pinned comment, or you can also explore my join button on YouTube. Now let us look at company's financials and try to understand why Samhi is in loss at the moment. So if you look at company's financials, the first thing you will notice is that company is consistently in loss. Why is that? So first of all, on the top line, Samhi's revenue fell down significantly during COVID, but it has recovered and grown exponentially post-COVID. Company's operating margins that fell down during COVID have also recovered significantly to trailing 12-month margins of 28%, which is very good. And company's operating profit have also zoomed post-COVID to current levels of 251 crore. But the main culprit here is interest cost that stood at 522 crore in FY23, although it is reduced to currently at 422 crore. On top of this, there is depreciation as well that has resulted in loss at profit before tax level. The reason for high interest cost is due to high debt. since company's business model is such that it identifies underperforming hotels and revamp them. Obviously, it requires a lot of capital, and that's where Samhi Hotel has a debt of 2,800 crore at the time of its IPO. However, the major purpose of IPO was to deleverage its balance sheet, and hence out of around 1200 crore that company is raised from the IPO, around 1100 crore would be utilized in reducing the debt. The catch here is that if you look at screener, it is still showing debt of 2,800 crore. So it's a matter of time. The moment this number comes down to 1700 odd crore, company's net loss would reduce significantly. It would directly result in significant fall in interest expense that is currently very high. And when that would happen, it would significantly reduce company's losses at PAT level. This slide gives a clear picture on how the debt reduction would result in fall in interest cost from 375 crore to 200 crore rupee. Although the timeline suggests it should have been done by December 31, but it seems it is taking some time to complete the debt reduction. In fact, in the latest con call, management guided that it's about a quarter or two that will be PAT positive on a sustainable basis. Now let us discuss why Samhi does not have individual promoter and whether it is risky or not. So if you look at company shareholding pattern, there are no promoters. It includes FIs that currently hold 64.4% stake, DIs hold 21.4% stake, and public has 14% stake. Generally, retail investors think that if there are no individual promoter, then company is fundamentally weak. That is a big misconception. In fact, some of the largest companies in India have no individual promoters, including ITC, ICICI Bank, HDFC Bank. In case of Samhi, it's been a professionally run company. It started in 2012 and needed funds to grow its business. Hence, promoter raised capital from various institutional investors and became a professionally run company. The important question here is, who are the existing shareholders of company? And it includes marquee names like Goldman Sachs. Then Government of Singapore has recently purchased huge stake in the company. Then it includes Bank of America Securities, HDFC Global Investment Fund, and so on. Likewise, DIs include names like SBI Mutual Fund, Tata Mutual Fund, ICICI Prudential Mutual Fund, and Nuvama Investments. In fact, recently marquee investor Madhusudan Kela has invested more than 1% stake in the company. Now, as far as leadership is concerned, it has a solid leadership team with Ashish Jakhanwala as chairman and MD of the company. Before founding Samhi, he worked with Interglobe Hotels as director. Then you have Rajat Mehta as CFO with more than 11 years in Samhi, which is itself 13-14 years old company. Even other people have been with Samhi for a long duration. Moreover, company is a very professional board with strong corporate experience. Do check out this detail in their investor presentation. Personally, I went through some of the interviews of Mr. Ashish Jakhanwala and loved the conviction and his vision with absolute clarity of thought. You should also watch some of his latest interviews. Now let us look at Samhi's future growth plans. Going forward, Samhi is betting on growth in Indian office space in top cities of India along with strong airline growth, which is growing at around 8 to 12% CAGR rate. Company is currently sitting on inventory of around 4,800 rooms, and out of this, there are around 900 rooms in their portfolio that needs to go through the transformation. So that would be one of the key focus area for the company over the next 4 to 6 quarters. Then company can add another 600 new rooms in its portfolio via existing hotels that they have acquired in Navi Mumbai via the ACIC portfolio. So recently Samhi has acquired ACIC that has 962 rooms and a land for development in Navi Mumbai. As of today, ACIC hotels are also managed by Samhi and they intend to give it to Marriott for day-to-day operations. So this slide gives a clear picture about Samhi's growth plan. In H1 of FY24, they did the IPO and acquired ACIC portfolio. In H2 of FY24, they intend to reduce the debt and finance cost that would directly result in sharp improvement in profitability. In FY25, they plan to open Holiday Inn Express in Kolkata, additional room in Holiday Inn Express Bangalore, renovation and rebranding of Caspia in Greater Noida, addition of apartment in Hyatt Regency Pune. In FY26, they plan to renovate and rebrand 4 Point by Sheraton Pune and Hyatt Regency Pune. In FY27, they plan to add rooms in Fairfield Chennai and open upper mid-scale hotel in Navi Mumbai. As a result, company expect to have around 5,400 rooms by FY28 that include 58% existing room, 17% from rebranding, 14% ACIC portfolio and 11% new inventory. Now let us look at company's valuation vis-a-vis its peers. Alright, so this is the peer comparison between Samhi Hotel, Indian Hotel, Lemon Tree, Chalet Hotel and EIH Limited. If you look at Samhi, currently it is trading around 218 with a market cap around 4,700 crore. Indian Hotel is trading at 570, market cap 81,000 crore. Lemon Tree at around 140, market cap 11,000 crore. Chalet is at 821 with a market cap of 16,800 crore. And EI is at 394 with a market cap of 24,600 crore. If you look at trailing 12-month revenue, Samhi trailing 12-month revenue is 883 crore, Indian Hotel is 6,500 crore, Lemon Tree is 991, Chalet is 1337, EIH is 2400 crore. Now, if you look at the profitability, as we discussed, Samhi is currently at loss at profit level. Indian Hotel profit is 1200 crore, Lemon Tree 157, Chalet is 232, EIH is 522. And if you look at the revenue growth, Samhi has grown at 129%. It also includes the growth due to acquisition of ACIC portfolio. Indian Hotel has grown at 28%, Lemon Tree has grown at 34%, Chalet Hotel has grown at 42%, EIH has grown at 43%. Now, if you look at the margins, Samhi has around 28% margin, Indian Hotel is 31, Lemon Tree is 49% margin, Chalet is 41, and EIH is at margin of 34%. In terms of profitability, we don't have Samhi's ROE and ROE because currently it is a loss. If you look at Indian Hotel, it has got a ROE and ROC of 12.7, 12.6, Lemon Tree is 13.6, 10.1, Chalet is 10.9, 9.2, and EIH is 11.4, 15.6. So profitability of these hotel stocks at the moment is on lower side, and mainly because they are also doing a lot of capex. Now, if you look at the P ratio of the company, Samhi we don't have P because it's in loss. Then Indian Hotel P is 69.4, Lemon Tree is 88, Chalet is 70, and EIH is 45. So P would look higher for this hotel stock, but here you got to look at the EV to EBITDA and price to sale. The reason why P is high because market is giving them a premium considering the upsurge in the hotel segment and considering the earning growth potential in the near term. Now, if you look at the EV to EBITDA and price to sale, Samhi has got EV to EBITDA of 24, which is the best as compared to all others. So Indian Hotel EV to EBITDA is 37.7, Lemon Tree 27, Chalet is 34, EIH is 25, and price to sale is 5.3, and Indian Hotel is 12.5, Lemon Tree is 11.2, Chalet is 12.6, and EIH is 10. So as compared to the other stocks in hotel segment, the valuation of Samhi at EV to EBITDA of 25 and price to sale of 5.3 looks better than Indian Hotel is 37.7, 12.5. Lemon Tree at 27 and 11.2, Chalet is 34 and 12.6, and EIH is 25 and 10. So one of the biggest risks for the company is cyclicity in hotel sector. As discussed before, hotel sector is cyclical in nature with RevPAR growth dependent upon supply and demand. While currently the hotel sector in India is going through upcycle due to high demand and low supply, today almost every top hotel company is coming up with new rooms, and eventually there will be enough supply to cater to the demand. And that's where there will be slowdown in RevPAR growth and eventually the profit growth. So you need to track the RevPAR growth and keep an eye on the cyclicity of hotel segment. So in this video, we discuss the fundamentals of Samhi Hotels. Company has a unique business model of acquisition-led strategy. Then tie up with top global brands, focus on business tourism in gateway cities of India with strong business environment and airports. Considering the upcycle in hotel industry, Samhi Hotel should be a clear beneficiary of this trend with growth in RevPAR. It has a very experienced board of directors and run by a professionally managed team. Company has currently 4,800 rooms and plan is to renovate around 900 rooms out of 4,800 and add another 600 rooms in the near term. Company is planning to reduce its debt by around 1100 crore and expecting to get profitable at PAT level by next quarter. And compared to its peers, company is trading at attractive valuation. But before investing your money, please be aware of the key risk of cyclicity in hotel sector. So this is it for this video. Now tell me in the comments what do you think about Samhi Hotel. And if you find this video useful, do share it with your friends. I'll see you next video. Till then, take care.